Let me ask you something. If you woke up tomorrow and the market was down 30%, what would you do? Because most people would panic, most people would sell, and a lot of people would watch their portfolio bleed and do absolutely nothing. But here's what the smartest investors in the world would do, and what Warren Buffett and Greg Abel are already positioning for with nearly 400 billion in cash just sitting on the sidelines. What they'd do is they would go shopping. Because a market crash isn't a disaster. It's a transfer of wealth from the people who panic to the people who are ready. And today, I'm going to show you exactly how I would act in that opportunity. So today, I'm not going to give you any 3 random stocks. What I'm going to do is I'm going to build you a portfolio. Okay, I'm going to build you one designed with intention that has AI infrastructure, logistics, and semiconductor hardware at the center. This portfolio is going to beat the S&P 500 every single year. It's going to generate huge amounts of passive income, and it's going to compound wealth until you're retired sitting on a beach before you're even 40 years old. Now, I want you to stick with me because one of these stocks is going to pay you a 9% dividend just for holding it. Another one of these stocks has a Palantir partnership announced this week that the market is not fully priced in. And our third stock is one sitting on a cash flow story that is going from 1 billion to 23 billion in free cash flow over just 5 years. So let's get into it. So the first stock that we're going to discuss here today is Zeta Global. Now, most people write Zeta off as just another advertising or tech company, and that's exactly what the market is missing. See, Zeta isn't an advertising platform. It's an AI and data powerhouse with one of the largest consumer intelligence databases on the planet, telling enterprises who to target before their competitors even know that the customer exists. Now, this is not your grandfather's marketing software. This is the future of enterprise AI marketing, and the market hasn't caught up yet. So, what makes Zeta uniquely powerful right now is the fact that this whole AI agentic revolution is somewhat destroying legacy SaaS businesses, okay? And this has seen Zeta pull back a little bit, but it is actually putting Zeta on steroids. See, AI strengthens their model, it doesn't threaten it. Now, Zeta trades today at a market cap of around 4 billion, and this is the opportunity because it trades at a forward PE of 19 times earnings. But management have actually guided to growing income by about 150%. So that is a huge disconnect between price and growth, and this is exactly where generational wealth gets made. So Zeta is trading today at a share price of $20, and I'm already buying it at this price. But if Zeta drops 20%, 30%, even 40% in a crash, that is absolutely no problem. I'm going to buy here and double down even more aggressively. So why are we so bullish on Zeta Global? Firstly, let's take a look at their Q1 2026 earnings. So what we can see here is the headline news, okay? Revenue came in 396 million for the quarter, up 50% year on year, even exceeding its prior guidance. So this is really, really bullish. There's very few companies in the world that can scale their revenue that material at that growth rate. Now, an even more impressive point is the average revenue per user. Additionally, the revenue per user, the ARPU, grew to 1.7 million, up 21%, okay? So that essentially means that every user on their platform is spending more. A really, really important point. And also here in the headline, you can see in the commentary, their Athena platform has delivered a return of 600% on marketing spend for customers. Now ask yourself, who walks away from a tool delivering a 600% return on investment? Nobody. That means if your marketing department spends 1 million on sales with Zeta, it's generating a trackable 6 million return. And this revenue comes from recurring multi-year partnerships. And that's why you see revenue compounding and retention above 100%. And this brings me to what I love the most about Zeta as a business. Let's take a look at their guidance. They've had 19 straight quarters of beating guidance and raising. Not one, not twice, 19 consecutive times. You are buying a company where management fully understands what they are building, and they are constantly over-delivering. That kind of consistency is extraordinarily rare. And if you look at it here, for Q2, it's suggesting that there's going to be a revenue growth rate between 36 to 37%. Their EBITDA is expected to grow between 47 to 48%. There's very few companies who can do this on the scale that Zeta are doing right now. And if you look at their full year guidance, they're expecting revenue to grow between 36 to 37%, EBITDA between 42 to 43%, and cash flow between 42 to 43%. Their margins are so impressive, it's even outscaling revenue, which means every dollar that the company takes in, the company are getting more efficient at churning that into profit. Now, what I want to talk about next is the new deal that Zeta Global have just agreed with Palantir. So Palantir and Zeta Global have announced a strategic partnership to build a unified data and AI infrastructure for the future of marketing. So what does that mean? When the company that powers the CAI's data infrastructure decides to rebuild its marketing cloud on your platform, you're no longer just a marketing company. You're now a leader in AI enterprise infrastructure. And this is a monumental vote of confidence. Palantir has essentially looked across the entire market and said, wow, Zeta is the best at what it does. Zeta is now a leader in enterprise AI infrastructure. And that is a huge vote of confidence because Palantir has now looked across the market, the entire market, and said, wow, Zeta is the best at what it does. And you can see here that David Steinberg, the co-founder of Zeta, has come in and said that the next generation enterprise value creation will come from connecting operational intelligence and customer intelligence. And he believes that this deal will drive Zeta Global's revenue by more than 100 million alone. So this is a strategic partnership that completely re-rates Zeta Global, adds more revenue, adds a vote of confidence from Palantir, and all in creates a very positive sentiment. Now, at TLI, one of the things we love about businesses is when they're founder-led and insider-owned. Okay, so I want you to join me here and look at this. So CEO David Steinberg has built this company from scratch, and we can see he still owns about 10% of the company. He knows every corner of his business, and now he has it running on AI. And the insiders, they own about 12%. Also, we have BlackRock, Vanguard, and State Street already positioned. And analysts are pricing a fair value per share around the $30 mark. Okay, now we've done our research and we can see here we have a price target around $32. Now, analysts are pricing Zeta Global around a fair value of $30 per share. And we believe that, yeah, maybe they're being cautious so they can continue to fill their pockets at lower prices. We have a price target around 32, which represents the average. But if you look at our DCF, this sits closer to $40 per share. And that's before the Palantir deal, which was just announced, okay? So that's a huge growth trajectory from here. Now, analysts are pricing Zeta around $30 per share, and we've got a price target around 32. But we believe some of these analysts are potentially being a little bit cautious. We believe the lower price targets creates a bit of an interim where they can continue to fill their pockets of Zeta with lower prices. The reason we say this, we've seen BlackRock, Vanguard, and State Street already positioned in Zeta, okay? But we have a discounted cash flow price target of $40 per share. So this represents about a 100% increase from where we currently are in the market. And that's before we factor in any of this additional 100 million in revenue from the Palantir deal. We will now hand over to Wojciech on our technical analysis team to give us a read on how Zeta is trading in the market.
Thank you, Sean. So Zeta technically looks really great and healthy. What is important, in my opinion, is that we have never failed to hold 200 weekly moving average, which signals a high demand and the willingness of buyers to step in when the price gets interesting and technically cheap. What is important as well, in my opinion, is that we have now reclaimed 50 weekly moving average, and that signals a bullish shift. So if we look at the chart, we have never failed to hold important fib levels, 0.786 over here, the golden ratio right here, and golden ratio once again in the last 2 weeks. So we are now still comfortably in our wave 3, and the short-term target remains at $38.
Thank you, Wojciech. So one line to close this out. Zeta is potentially the most misunderstood AI compounder on the market today. It's got 50% revenue growth, a new Palantir partnership, and the market still hasn't figured out exactly what it is. Now, if the market was to crash tomorrow, I'd have no hesitation putting 20 to 30% of my portfolio in Zeta. So we're going to move on to our second stock pick today, and this one is very intentional. Some of you will have heard me talk about this before. The company is UPS. Now, before you switch off, hear me out, because this is where the portfolio gets really interesting. So UPS pays a dividend today of about 6.2%. If the stock drops 30% in a crash and the dividend holds, which it will, because UPS has maintained its dividend for over 2 decades now, you're looking at a dividend yield of 8.9%. Let's call it 9%. Now, let me show you exactly what that means for your future. So, what I want to introduce you to is the rule of 72. And essentially here, you divide 72 by your annual return. Today, UPS trades at a dividend yield of 6.2, okay? But if this increases to 9, this essentially tells you that at 9%, that's only holding for 8 years. 8 years of holding and your dividend income alone has returned your entire investment. That's before the stock even moves a single dollar. So let's assume you've got UPS at a discount of 30%. The dividend yield that you've locked in is now 9%. You can do 2 things with that income. Firstly, you can reinvest it and build a compounding dividend machine that props up your entire portfolio without you ever having to add another cent. Secondly, you could treat it as a pension income, okay? So 100,000 invested in UPS at a 30% drawdown is going to bring you 9,000 additional dollars every year. That's fixed, that's passive every single year, just for holding. And see, this is how long-term wealth actually gets built. It's not from chasing the next 10x. It's from owning world-class businesses that pay you while you wait. So why UPS specifically? It's got 22 million packages delivered every single day. The global logistics infrastructure UPS has cannot be replicated. It will cost hundreds of billions and decades of time. So you cannot spin up a competitor to UPS in just 5 years. This is a permanent, irreplaceable moat. Now, 2025 was a transformational year. It had 40,000 layoffs, renegotiated Amazon contracts, automation across the network, and operational streamlining. Now, the market read that as weakness. We read that as right-sizing the business for the next decade. And that is a fundamental difference in how you see this opportunity. And here's the vision that really excites me. Think about a fully autonomous UPS, driverless trucks, robotic sorting, automated last mile delivery. UPS is already investing in this. And if you look here, you can see that their Chief Strategy and Transformation Officer has detailed that he is fully exploring the idea of autonomous driverless vehicles. They've been doing this for years, and they expect it to greatly reduce future labor costs and make them more competitive. So these labor costs that are compressing margins today, they largely disappear in a world of robotics and autonomous vehicles. The operational leverage that would transition would be extraordinary. It is more likely a robot delivers you your next parcel than a human in 10 years' time from now. And UPS is one of these companies that has both the capital and the infrastructure head start to lead that revolution. So what we can see here is that their Chief Strategy and Transformation Officer, Scott Price, has mentioned that they have been trialing out these autonomous and driverless vehicles for years now, okay? There's partnerships in place and there's constant reinvestment. Now, I want you to think about the labor costs that are compressing today's margins. These costs largely disappear in a world of robotics and autonomous vehicles. The operational leverage that would transition from this would be absolutely extraordinary. And I want you to think about it because it is more likely a robot delivers your next parcel than a human in 10 years' time. So on top of all this, I want you to think about it. If the market crashes and capital starts rotating out of high multiple tech names, where does it go? It goes into real assets, hard infrastructure, dividend players. It goes straight into UPS. On top of all this, if the market crashes and capital starts rotating out of tech names, where does it go? It goes into real assets, hard infrastructure, dividend payers. It goes straight into UPS. So as always, let's look at what our research paper has to say. So we produced this price target on UPS back in January. Today, UPS is trading about $108, $107, the same as it was back then, and we believe firmly that UPS is going to move towards an average price target of 125, but the underlying cash flow suggests it could go as high as 130. Now, that could be a 20% upside just on a capital gain basis, and that's pretty good. But remember, we're buying this from a dividend perspective. This is why we've highlighted it as a buy, a defensive play, a play on a dividend. So if you get UPS after a crash of about 30%, you're going to be getting an annual dividend of around 9% per year, plus all this upside if you're able to wait out that crash. And for that reason, UPS is a long-term hold for me in any portfolio. It's a stock that stabilizes your portfolio and compounds over the long run, with fixed income being delivered every single year. Now, let's get a quick update from Wojciech in our technical analysis department.
UPS now looks technically very strong. It has bottomed at 0.786 FIB, taken from all-time lows to all-time high right here, and it found bottom on historical horizontal supports. So far, this has been a textbook wave 1 and 2 with precise ABC correction, and we are sitting right above 0.618 FIB, which is our golden ratio, and we have seen a precise ABC correction. Right now, we expect a move toward 200 weekly moving average at the very least, and our wave 3 target sits at 1.618 FIB at $158. This looks very healthy, and the worst case here is consolidation and very generous dividend. We are happy with this position, and there are no concerns with this chart. This is set to move higher.
Thanks, Wojciech. So to wrap up UPS, a 9% dividend from a business with an irreplaceable physical moat, automation tailwinds, and a 2-decade dividend track record. In a crash, this becomes one of the most compelling income opportunities in the entire market. So the third and last stock that I want to walk you through is AMD, one of TLI's top 20 for 2026. And we're going to quickly just jump onto Yahoo Finance to look at how it's appreciated over the last year to date, where the multiples are at, and what our initial assessment is. Now, AMD has been one of the strongest performers in the semiconductor space. The chart may be a little bit extended. We can see year to date it's ran about 143%, over the last year 300%, and the multiples may look a little bit rich. Okay, we got forward PE of 74%, trailing PE nearly 200, revenue multiple 22, which is very, very high. But I guess in the semiconductor, when you compare it to the likes of Nvidia, it's a little bit lower, a bit less of a premium, and you're paying 104 times EBITDA. So things are starting to get a bit, I guess, richly priced here, and we'd like to see them come down. And that's why we want to see, a company of AMD's quality have a little bit of a pullback and a new entry level for us. So why AMD at a lower price? Firstly, look at the market share. The narrative used to be that Nvidia had no real competition, and that story is quickly changing in AMD's favor. The MI300X and next-gen AI accelerator roadmaps position AMD as the genuine enterprise alternative to Nvidia in data centers. Now, AMD doesn't need to beat Nvidia anymore. To generate extraordinary returns, it just needs to capture meaningful market share and show that both AMD and Nvidia can coexist. Secondly, you gotta love their CEO, Lisa Su, arguably the best CEO in technology with a decade of exceptional execution. So the third reason that we're looking to buy AMD in a portfolio reset if there was a market crash is purely based on free cash flow. So we're going to use Market Screener here just to look at free cash flow, the past trajectory, and where it's going over the next few years. Now, if you think about it, all of the Mag 7 are being scrutinized for their greater than 700 billion spend in CapEx, and AMD is quietly compounding free cash flow at a staggering rate. If you look at 2023, they had 1 billion in free cash flow, 2.4 in 2024, 5.5 billion in 2025, and now the forecasts are still staggering. 2026, 8.3 billion, 2027, 15.6 billion, and 2028, 24 billion. This is where business value actually lives, not in revenue growth headlines, in cash generation, in the compounding engine underneath. And this means that AMD is not only generating cash, but it's keeping it too. Now, let's keep it real and look at AMD's most recent quarterly report. A lot of people find these boring, but I think they're the best place to see where the business is actually going. And what we can see here is management is guiding to 46% increase in revenue on the next quarter alone. Gross margins are expected to rise to 56%, 53% in the last quarter, and previously around 40% 5 years ago. This is a business getting structurally more profitable every day as the company scales. So here's what the market consistently misses about AMD. These chips are not purely an AI play. They power smartphones, laptops, TVs, banking systems, ERP systems, autonomous vehicles, and even surgical equipment. That's just a short overview of the list. Every layer of the digital world runs on this hardware. The AI and data center business is just the cream at the top, but beneath it there is a vast, diversified, always on demand base that provides a floor the market never fully priced in. Now, let's look at our AMD price target that we previously issued in May. Now, in our previous price target, we were very specific in rating this. We rated AMD as market perform over the short term, but a strong buy over the long term. Since then, the stock has ran from $465, eclipsing our average price target of $525 and now pulling back around the $520 mark. So again, it's run very hard over the last year, but any market pullback we see is a major long-term opportunity. And our current discounted cash flow still runs to about $540. So a limited upside sort of from where we are in the market based on cash flow and the fundamentals. And that's why we believe if the market was to pull back 20-30%, we are going to buy up so much AMD because it is a long-term structural thesis, okay? The AI hardware is monetizing and is monetizing right now and will continue to do so for years to come. But before we finish up, let's see what Wojciech is seeing for AMD on the technical analysis side.
AMD is in a bit different situation compared to UPS and Zeta. It ran very strong and Wave 3 has hit all of our targets over here. So right now we have two scenarios. Either Wave 4 has completed over here when it touched 0.236, or we can see a consolidation and possibly lower low towards 0.382 or 0.5. Then we expect further upside for Wave 5 at $686. While this run has been strong, we believe this is not all from AMD, and any downside might be an opportunity for further highs. We like AMD, they have more in the tank, and we believe this will show us a bit more in the near future.
So where do we stand? 3 stocks, 3 completely different businesses, 3 genuinely different sources of return. Zeta, perhaps the most misunderstood AI compounder on the market, a $4 billion business growing revenue of 50%, with 19 consecutive beat and raises, a Palantir partnership that redefines what the company is, and a valuation the market hasn't caught up on yet. UPS, not a legacy logistics business, a hard asset moat with an irreplaceable global network, a 9% dividend yield in a crash scenario, and an automation and robotics story that could structurally transform its cost base over the next decade. And AMD, the AI hardware trade that is already monetizing. Free cash flow going from 1 billion to a forecasted 23 billion. A CEO who believes compute is 100 times larger from here, and a chip business that powers every corner of the digital world. These are not trades. They are not ideas we're watching for next week's price movements. These are businesses we are looking to own through a full market cycle, while they compound, while they generate cash, and while the rest of the market is slowly catching up to what we already see. Because that's where real wealth gets built. Not in a panic, not in a crash, but in the decisions you make in the days thereafter. Now, if this video gave you any interesting ideas, drop them in the comments below and we'll chat through. But I want to know, which of these 3 companies are you most interested in? And if you're not subscribed yet, we put out research like this every single week. Hit subscribe, turn on the notifications, and I'll see you in the next one.